Look, I need to be direct with you right from the start. I'm Ray Dalio, and in my 5 decades of studying economic patterns and building Bridgewater Associates into the world's largest hedge fund, I've learned to recognize certain signals. And right now, as we move into 2026, I'm seeing a combination of factors that I haven't witnessed together since the 1970s. If you're over 60 years old, what I'm about to share with you could mean the difference between a secure retirement and a devastating financial setback. I don't say this lightly. I've seen the crashes of 1987, 2000, 2008, and 2020. I've studied every major economic crisis going back to the 1920s. And what's forming right now has characteristics that should concern anyone who's relying on their savings to carry them through the next 20 or 30 years of their life. Here's what keeps me up at night. We're sitting at the intersection of three massive forces: unprecedented debt levels across governments and corporations, a shift in the global reserve currency system that most people don't even realize is happening, and a fundamental change in how central banks are responding to inflation. These three forces are creating what I call a paradigm shift, and most seniors are completely unprepared for what this means for their portfolios. Let me start by explaining what I mean by a paradigm shift, because this isn't just academic theory. A paradigm is the environment that we all assume will continue. It's the water that fish don't even know they're swimming in. For the past 40 years, since the early 1980s, we've been living in a paradigm of declining interest rates and declining inflation. Every time the economy struggled, central banks could cut rates, and that would stimulate growth. Bonds reliably went up in value. Stocks benefited from cheaper borrowing costs. It was a beautiful 4-decade run, but that paradigm is over. It ended sometime around 2021 or 2022, and most people haven't adjusted their thinking yet. We're now in a world where central banks are constrained. They can't just cut rates to zero anymore without risking runaway inflation. Government debts are so massive that traditional monetary policy doesn't work the way it used to. And this creates enormous risks for anyone who built their retirement strategy, assuming the old paradigm would continue forever. I want you to understand something fundamental about how I think about markets and economies. Everything moves in cycles. There are short-term debt cycles that last about 5 to 8 years. There are long-term debt cycles that last about 75 to 100 years. And there are even longer cycles in the rise and fall of empires and reserve currencies that can span centuries. Right now, we're near the end of a long-term debt cycle, and we're also witnessing what might be the beginning stages of a shift away from the dollar's dominance as the world's reserve currency. Now, I know that sounds abstract, so let me make it concrete. When I say we're near the end of a long-term debt cycle, what I mean is this. Since World War II, the United States and much of the Western world has been accumulating debt. Government debt, corporate debt, household debt. For decades, this worked fine because economic growth was strong enough to service that debt and inflation was under control. But we've reached a point where the debt levels are so high relative to income that we can't grow our way out anymore. The numbers are staggering. The U.S. government debt is now over $34 trillion. That's more than 100% of GDP. Corporate debt is at record highs. And even though household debt has come down slightly since 2008, it's still enormous. When you add it all up, total debt in the system is somewhere around 300% of GDP. That's higher than it was during the Great Depression. Here's why this matters to you specifically if you're a senior. When debt levels get this high, governments and central banks face an impossible choice. They can either allow a deflationary collapse, where all that debt gets defaulted on and the economy crashes, or they can print money to inflate away the debt. History shows us that governments almost always choose the second option. They print money, they create inflation, and they effectively reduce the real value of the debt over time. But here's the catch. If you're a retiree living on a fixed income, Inflation is your worst enemy. It silently erodes your purchasing power every single day. If inflation runs at 5% per year, which is actually modest compared to the 1970s, your money loses half its value in just 14 years. For someone who's 65 and planning to live to 90, that's catastrophic. Let me paint you a picture of what happened in the 1970s because I lived through it and studied it intensely. From 1970 to 1980, the purchasing power of the dollar fell by more than 60%. If you had $100,000 in a savings account in 1970, by 1980, it could only buy, about $40,000. Could have bought a decade earlier. Retirees who thought they had adequate savings suddenly found themselves struggling to make ends meet. And here's what most people don't realize. The official inflation numbers don't capture the full picture. The way we calculate inflation today is very different from how we calculated it in the 1970s and 1980s. If we use the old methodology, current inflation would be much higher than the reported numbers. Healthcare costs, which are a huge expense for seniors, have been rising much faster than general inflation for decades. So what am I seeing right now that makes me think we could be heading into a similar period? Several things. First, the Federal Reserve is trapped. After raising interest rates aggressively in 2022 and 2023 to fight inflation, they now find themselves in a difficult position. Government interest payments on the national debt have exploded. We're now spending over $1 trillion per year just on interest payments. That's more than we spend on defense. It's unsustainable. This means the Fed is under enormous pressure to cut rates, not to stimulate the economy, but simply to reduce the government's debt burden. But if they cut rates too much, inflation comes roaring back. It's a no-win situation, and it's exactly the kind of environment that leads to policy mistakes. Second, I'm watching the shift happening in global trade and currency relationships. For decades, the US dollar has been the dominant reserve currency. Countries around the world held dollars and bought U.S. Treasury bonds because they needed dollars for international trade, especially for buying oil. But that's changing. China, Russia, Saudi Arabia, and other countries are increasingly conducting trade in their own currencies or in alternative arrangements that bypass the dollar. This is a slow-moving trend, but it has profound implications. If demand for dollars decreases globally, it means there will be more dollars circulating in the U.S. economy, which is inherently inflationary. It also means that Treasury bonds become less attractive to foreign buyers, which pushes up interest rates and puts more pressure on the government's debt burden. Third, I'm concerned about the wealth gap and political polarization. When wealth inequality gets extreme, as it is now, it creates political instability. We see this throughout history. The wealth gap today is approaching levels we haven't seen since the late 1920s, right before the Great Depression. This leads to political movements that advocate for wealth, redistribution, higher taxes on the wealthy, and more government spending on social programs. Regardless of your political views, the economic reality is that these pressures make it more likely that we'll see inflationary policies in the years ahead. Now, let me tell you what I think most seniors are getting wrong about their portfolios right now. The traditional 60-40 portfolio, 60% stocks, 40% bonds, was designed for the old paradigm. It worked beautifully for 40 years. When stocks went down, bonds typically went up, providing a cushion, but in the new paradigm we're entering, stocks and bonds can go down together, which is exactly what we saw in 2022. Why does this happen? Because both stocks and bonds are hurt by rising interest rates and rising inflation. When inflation comes back, central banks have to raise rates to fight it. Higher rates make bonds lose value, and higher rates also hurt stocks because they make borrowing more expensive for companies and they make future earnings less valuable in today's dollars. So if the traditional 60/40 portfolio doesn't work anymore, what should you do? This is where my approach, which I call all-weather investing, becomes critical. The idea is to build a portfolio that can perform reasonably well in any economic environment, whether we have growth or recession, whether we have inflation or deflation. You want to have assets that will protect you. Let me break down the different economic environments and what performs well in each. In a growth environment with low inflation, stocks do great. This is what we had for most of the past 40 years. In a recession with falling inflation or deflation, bonds do great. In a stagflation environment where you have slow growth but high inflation, neither stocks nor bonds do well. This is where you need other assets. What performs well during stagflation? Commodities, especially gold and energy, inflation protected, bonds, also called TIPS, real estate, if you own it outright without too much debt, and certain types of stocks, particularly commodity producers and companies with pricing power that can pass costs on to customers. My all-weather portfolio is designed to have roughly equal risk allocation across these different environments. It's not equal dollar allocation, but equal risk allocation. This typically means you need more bonds than stocks because bonds are less volatile, but you also need meaningful allocations to inflation hedges that most traditional portfolios completely ignore. Here's a rough framework. About 30% in stocks, focusing on high-quality companies with pricing power. About 40% in long-term bonds, because they do well if we get a deflationary shock. About 15% in intermediate-term bonds, about 7.5% in commodities, including gold, and about 7.5% in inflation-protected securities. Now, I want to be very clear. These aren't exact prescriptions. Your specific situation depends on your health, your expenses, whether you have a pension, your Social Security income, and many other factors. But the principle is what matters. You need diversification, not just across different stocks, but across different economic scenarios. Let me talk specifically about what I think seniors should be doing differently right now. First, you need to think very carefully about your cash position. In normal times, I'd say keep 6 to 12 months of expenses in cash. But right now, I'd suggest having at least 18 to 24 months of expenses in cash or very short-term treasury bills. Here's why. If we do get a market crash or a recession, you want to have enough cash to live on without being forced to sell stocks or bonds at depressed prices. But equally important, you want to have cash available to buy assets when they're on sale. Some of my best investments ever were made during times of maximum fear. In March of 2009, during the depths of the financial crisis, I invested $5 billion in Goldman Sachs. I got very favorable terms because they desperately needed capital. That investment made billions in profits for Bridgewater, but I could only make that investment because I had cash available when others were panicking. You might not have billions to invest, but the principle is the same. If you have adequate cash reserves, you can be greedy when others are fearful, to quote my friend Warren Buffett. Without cash, you're forced to be fearful when others are fearful, and that's how you lock in losses. Second, I want you to really examine your stock holdings. Do you own high-quality businesses, or are you chasing growth stories and speculative plays? At your age, you cannot afford to gamble. I look for companies with several characteristics. They have strong competitive advantages that allow them to maintain profit margins even in tough times. They generate lots of free cash flow that they return to shareholders through dividends. They have strong balance sheets with manageable debt levels, and they operate in industries that are likely to remain relevant for decades. Think about companies that provide essential products or services, healthcare, utilities, consumer staples. These aren't exciting, but they're dependable. I'd much rather own a boring business that consistently makes money than a flashy technology company that might be obsolete in 5 years. Let me give you a specific example of how I think about this. Consider a major pharmaceutical company that's been around for over 100 years. It has dozens of important drugs, a massive research pipeline, and sells products that people need regardless of economic conditions. Yes, it faces patent cliffs and regulatory challenges, but it has proven over a century that it can navigate these issues. Compare that to a software company that's valued at 50 times earnings based on hopes of future growth. Which one would you rather own if you knew you couldn't sell it for 10 years? Third, I want you to think seriously about inflation protection. Most seniors have way too little exposure to assets that perform well during inflation. Gold is the most obvious one. Now, I know gold doesn't pay interest or dividends, and that bothers a lot of people. But gold has been a store of value for 5,000 years. When paper currencies lose purchasing power, gold typically maintains its value. I'm not saying put 50% of your portfolio in gold, but having 5 to 10% in gold or gold mining stocks gives you important insurance against currency debasement and inflation. During the 1970s, from 1971 to 1980, gold went from $35 per ounce to over $800 per ounce. That's more than a 20-fold increase. It protected people who owned it from the ravages of inflation. Similarly, consider commodities more broadly: energy, agricultural products, industrial metals. These tend to do well when inflation is rising. You don't need to buy physical barrels of oil. There are commodity funds and ETFs that give you exposure to these markets. Treasury inflation-protected securities, or TIPS, are another important tool. These are government bonds where the principal adjusts with inflation. If inflation runs at 4%, your principal goes up by 4%. They're not perfect because they use the government's inflation calculation, which understates real inflation, but they're still better than regular bonds in an inflationary environment. Fourth, if you own real estate beyond your primary home, think carefully about how it's financed. Real estate can be a great inflation hedge, but only if you own it with little or no debt. If you have rental properties with large mortgages, rising interest rates can squeeze your cash flow even as the property value might be going up. I generally prefer to own real estate outright or with very modest debt levels. Your primary residence is a little different. If you have a low fixed rate mortgage from the past few years, there's no rush to pay it off. That's actually cheap financing that gets easier to pay in real terms as inflation erodes the value of money. But if you're carrying a home equity line of credit or a variable rate mortgage, those should be paid down aggressively. Now, let me address something that I know is on many seniors' minds: Social Security and Medicare. There's a lot of anxiety about whether these programs will be there for you. Let me give you my honest assessment. Social Security will be there in some form, but benefits will likely be cut either directly through formula changes or indirectly through taxation and means testing. The trust fund is projected to be depleted by 2033 or 2034. At that point, incoming payroll taxes will only cover about 80% of promised benefits unless Congress acts. Medicare faces even bigger challenges. Healthcare costs continue to rise faster than general inflation, and the Medicare Trust Fund for hospital benefits is projected to be depleted even sooner than Social Security. What does this mean practically? It means you should plan conservatively. Don't assume you'll get 100% of your currently promised Social Security benefit. Build in a buffer and assume that Medicare will cover less of your healthcare costs in the future than it does today. You need to save more to make up for these potential shortfalls. This brings me to healthcare costs, which are one of the biggest risks facing seniors. The average 65-year-old couple will spend over $300,000 on healthcare during retirement, and that's just for Medicare premiums, deductibles, and copays. It doesn't include long-term care, which can easily cost $100,000 per year for a nursing home. Long-term care insurance is expensive and has gotten more expensive as insurance companies have realized they underprice these policies. But the alternative, paying out of pocket, can devastate your retirement savings. If you can afford long-term care insurance, it's worth considering. If you can't, you need to have a plan. That might mean setting aside a specific pool of assets, perhaps $200,000 to $300,000, that you earmark for potential long-term care needs. Let me shift now to talk about sequence of returns risk, because this is something that can destroy a retirement even if your average returns are fine. Sequence of returns risk is the danger that you'll experience poor market returns early in retirement, forcing you to sell assets at depressed prices to fund your living expenses. This locks in losses and means you have less capital to benefit from any eventual recovery. Here's a simple example. Imagine two retirees, both starting with $1 million. Both withdraw $50,000 per year. Both experience the exact same returns over 20 years, averaging 7% per year. But retiree A experiences negative returns in the first few years, then strong positive returns later. Retiree B experiences strong returns early, then negative returns later. Even though their average returns are identical, retiree A will likely run out of money, while retiree B will be fine. This is why the first 5 to 10 years of retirement are so critical. If you retire right before a major market crash, it can permanently impair your financial security. This is also why I'm so concerned about the current environment. If we do get a major correction in 2026 or 2027, anyone who just retired in the past few years could be in serious trouble unless they've planned for this risk. How do you protect against sequence of returns risk? First, have those cash reserves I mentioned. 2 years of expenses in cash means you don't have to sell stocks during a crash. Second, consider a bucket strategy. Keep 5 years of expenses in cash and short-term bonds, the next 5 years in more moderate investments, and only put money you won't need for 10 plus years into stocks. Third, be flexible with your spending. If markets crash, cut your discretionary spending for a few years. Take cheaper vacations, delay home renovations, reduce gifts to family members. This flexibility can make an enormous difference in the long-term survival of your portfolio. I also want to address annuities because I know many seniors are pitched these products. Annuities can play a role, but you have to be very careful. A simple immediate annuity, where you give an insurance company a lump sum and they pay you a fixed amount every month for life, can make sense for a portion of your portfolio. It's essentially buying yourself a private pension. The rates aren't great right now, but they've improved from a few years ago. What I'm skeptical about are complex variable annuities and indexed annuities with all sorts of bells and whistles, guaranteed minimum returns, death benefits, income riders. These products are expensive, hard to understand, and the insurance company always wins in the long run. If someone is pitching you a complicated annuity, ask them to explain in simple terms how it works, what the fees are, and what the insurance company makes on it. If they can't or won't explain it clearly, walk away. Let me talk about taxes, because tax planning is crucial in retirement and becomes even more important in the kind of environment I'm forecasting. Right now, we have historically low tax rates. The Tax Cuts and Jobs Act of 2017 lowered rates substantially, but many of those provisions are set to expire after 2025. It's likely that taxes will go up in the coming years, potentially significantly. This creates an opportunity for something called Roth conversions. If you have money in traditional IRAs or 401k accounts, you've never paid taxes on that money. When you withdraw it in retirement, you'll pay ordinary income tax rates. But you can convert some of that money to a Roth IRA, paying the taxes now at today's rates, and then all future growth and withdrawals are tax-free. This can make a lot of sense if you believe taxes are going up, which I do. Yes, you have to pay taxes now on the converted amount. But if you're in a low tax bracket year, perhaps right after you retire, but before you start taking Social Security, you can convert chunks of money at relatively low rates. Then that money grows tax-free forever, and you won't have to worry about required minimum distributions forcing you to take taxable income later. I also think carefully about asset location, meaning which types of investments you hold in which types of accounts. Your most tax-inefficient investments, like bonds and real estate investment trusts that throw off a lot of taxable income, should be in your IRA or 401k accounts where that income is sheltered. Your most tax-efficient investments, like stocks that you plan to hold for a long time, can be in taxable accounts where you can benefit from lower long-term capital gains rates. Now, I want to talk about a topic that many people find uncomfortable but is absolutely critical: estate planning and legacy. If you don't have an updated will, power of attorney, and healthcare directive, stop reading this and go get those done immediately. Seriously. I've seen families torn apart by disputes over estates, and I've seen people's final wishes completely ignored because they didn't document them properly. Beyond the basic documents, think about how you want to pass on your values and your knowledge, not just your wealth. One of the things I'm most proud of is creating Principles, my book that lays out the decision-making frameworks I've developed over my career. It's a way to pass on not just what I know, but how I think. You can do something similar for your family. Write down your life lessons, your regrets, your proudest moments. Record videos explaining why you made certain decisions. This kind of legacy is often more valuable than money. If you have significant wealth, consider how estate taxes might impact what you can pass on. The current estate tax exemption is very high, over $13 million per person, but this is also set to be cut in half after 2025 unless Congress acts. If your estate is anywhere near these levels, you need sophisticated estate planning with trusts and gifting strategies. This is not do-it-yourself territory. You need an experienced estate planning attorney. Let me address one more critical topic: scams and financial abuse. Seniors are targeted relentlessly by scammers, and the sophistication of these schemes has increased dramatically. I've studied fraud extensively because in my role managing money, protecting against fraud is crucial. The most important defense is skepticism. If something sounds too good to be true, it is. If someone is pressuring you to make a quick decision, it's probably a scam. Never give out personal information to someone who calls you. If your bank or the IRS or Social Security supposedly calls you, hang up and call them back at a number you look up independently. Don't click links in emails, even if they look official. Many scams target people's emotions, pretending to be grandchildren in trouble or promising exclusive investment opportunities. Take your time. Consult with a trusted family member or friend before making any significant financial decision. Financial abuse by family members or caregivers is also unfortunately common. If someone is pushing you to change your will, give them access to your accounts, or make them joint owners of your property, be very cautious. These can be legitimate arrangements, but they can also be exploitative. Having independent legal and financial advisors who don't benefit from your decisions is important protection. I want to return now to the bigger picture of what I see coming in the economy. I've laid out the challenges, the debt trap, the inflation risk, the currency shifts, but I want to be balanced. There are also reasons for optimism. Human ingenuity and innovation continue to advance. Technology is creating productivity gains that were unimaginable a generation ago. The world is becoming more interconnected, which creates opportunities even as it creates challenges. The key is to prepare for a range of scenarios, not to bet everything on one outcome. I don't know for certain that we'll have high inflation. We might instead have a deflationary bust as all this debt implodes. We might muddle through with moderate inflation and slow growth for a decade. Or we might get lucky and policymakers might thread the needle perfectly, achieving a soft landing. What I do know is that we're at a major inflection point. The paradigm that governed the economy for 40 years is over. We're transitioning to something new, and transitions are inherently uncertain and risky. This is why diversification and balance are so crucial. You want a portfolio that can survive and even thrive in different scenarios. Think of it like this. You're building a boat that has to carry you through unknown waters. You don't know if you'll face storms or calm seas, warm temperatures or freezing cold, so you prepare for everything. You have a strong hull, multiple sails, an engine for when there's no wind, supplies for emergencies. That's what a properly diversified portfolio does. It prepares you for whatever comes. Let me give you a final framework for thinking about your finances. I believe in what I call radical transparency and radical truth. This means being brutally honest with yourself about your situation. Don't sugarcoat it. Don't assume things will work out. Look at the numbers clearly. How much do you have? What are your fixed expenses? What would happen if your portfolio dropped by 30%, 40%? What if inflation runs at 6% per year for the next decade? Run the scenarios. Use retirement calculators. Many are available free online. Stress test your plan. If it only works if stocks return 10% per year every year with no crashes, that's not a plan. That's a hope. A real plan works even in difficult scenarios. And once you have a plan, you need discipline to stick to it. The biggest mistakes I see people make are emotional. They panic and sell at the bottom. They get greedy and buy at the top. They abandon their strategy at the worst possible time. This is why having a written investment policy statement can help. It's a document that lays out your strategy, your allocation targets, your rebalancing rules, your decision-making process. When emotions run high, you can refer back to this document and remind yourself of the reasoning behind your plan. The deadline, I'm emphasizing the urgency of acting now rather than waiting, comes from my conviction that we're at a turning point. The next 12 to 24 months will likely be very telling about which direction the economy goes. If I'm right about the pressures building, we could see significant market volatility and economic disruption. But even if I'm wrong, even if things continue to muddle along, having a robust plan doesn't hurt you. It just means you're prepared. The worst thing you can do is nothing. The second worst thing is to make dramatic changes based on fear without thinking them through. What I'm advocating for is thoughtful, careful preparation. Review your situation, understand the risks, make adjustments to reduce your vulnerability, build in buffers and safety margins. And then once you've done that, live your life. This is ultimately what all of this is about. Money is a means, not an end. The purpose of financial security is to give you freedom and peace of mind, freedom to spend time with people you love, freedom to pursue interests and hobbies, freedom to be generous and make a difference in the world, peace of mind that you can handle whatever comes, that you won't be a burden to your children, that you can maintain your dignity and independence. I've spent my entire career studying markets and economies, but I've learned that the most important thing isn't maximizing returns. It's aligning your financial life with your values and goals. It's making decisions that let you sleep well at night. It's being able to look at yourself in the mirror and know that you've been responsible with the resources you've been given. As I look ahead to the challenges facing seniors in 2026 and beyond, I feel a real sense of urgency about making sure people are prepared. But I also feel optimistic about those who take action. The principles I've shared with you today, diversification across economic scenarios, maintaining liquidity, focusing on high quality assets, protecting against inflation, being tax efficient. These aren't complex or exotic strategies. They're based on common sense and decades of experience. You have more control over your financial destiny than you might think. You can't control what the Federal Reserve does or whether we have a recession or what happens to the dollar. But you can control your spending, your savings, your asset allocation, and your behavior. Focus on what you can control and prepare for multiple possible outcomes of what you can't control. Take action this week, not next month or next year. Review your portfolio. Make sure you have adequate cash reserves. Check that your estate documents are in order. Talk to your family about your plans and wishes. Consider whether you need professional advice, and if so, seek out a fiduciary advisor who is obligated to put your interests first. The future is uncertain, but with proper preparation, you can face it with confidence rather than fear. That's my goal for you, not to scare you, but to motivate you to take the steps necessary to protect yourself and your family. The time to fix the roof is when the sun is shining, not when it's raining. Right now, we still have time. Use it wisely